Hey everyone, and welcome to the Deep Dive. Today we're going to be really diving deep into financial accounting
Yeah,
using Christine Jonick's book, Principles of Financial Accounting.
it's a great book.
Yeah, so basically what we're going to do today is just really break down some of the core concepts
Right.
using this book as our guide.
You know what's really cool about this book is that it takes you from like the really basic, accounting 101,
Yeah?
all the way to some pretty complex stuff like, depreciation and investments.
Okay, so I think a really good place to start would be with those 5 basic categories of accounts:
Okay.
assets, liabilities,
Right.
stockholders' equity, revenue, and expenses.
Yeah, it's a lot to keep track of, but if you think of it like sorting your finances into like
Yeah.
labeled containers, it becomes much easier.
Yeah, like instead of shoes and sweaters, we're talking about cash and,
All right, exactly.
equipment and loans and things like that.
Yeah. So like assets are what a business owns, right?
Yeah.
So that's things like their cash, inventory,
Yeah.
maybe they have patents, things like that. Liabilities are what the business owes to other people.
Gotcha.
So think loans, unpaid bills, that sort of thing.
Okay, so assets are like the things you have and liabilities are the things you owe.
Exactly.
So where does stockholders' equity fit into that whole container analogy?
Stockholders' equity represents the owner's stake in the business.
Right.
So you take the assets, subtract the liabilities, what you have left over is the stockholders' equity.
Okay, so like the net worth of the
Yeah.
business from the owner's perspective.
Yeah.
Okay, and then revenue and expenses. Those seem pretty straightforward.
Yeah, revenue is the money coming in from selling whatever goods or services the business offers.
Okay,
And expenses are the costs of doing business.
got it.
Rent, salaries, advertising, all that stuff,
So Jonick brings up the accounting equation pretty early on.
right?
Assets equals liabilities plus stockholders' equity.
It's fundamental.
Yeah, it seems super important.
Yeah, it's really the bedrock of accounting because like every financial transaction, no matter how small,
Yeah.
needs to keep this equation balanced.
Wow.
So like, let's say a company buys new equipment,
Right.
but they take out a loan to do it.
Yeah.
The assets go up because now they have the equipment,
Right.
but the liabilities also go up because now they have the loan.
So it's like this constant
Yeah.
balancing act.
It is, and that's where the accounting cycle comes in.
Okay, what is that?
It's the step-by-step process that businesses use to keep track of all of their financial transactions.
Okay.
You can almost think of it like a runner going around a track. So
Right.
the first step is recording each transaction, like marking the start of a lap.
Okay.
And that's called journalizing.
Okay.
And then we post those transactions to ledgers, like keeping track of all the lap times.
Okay, so we're like building this
Yeah,
detailed record of like all the financial.
absolutely. We want a detailed record of everything that's happening. And from that, we can create the financial statements, and those are like the summary of the runner's performance.
Okay,
So we have the income statement that tells us how much profit was made
gotcha.
during the period. We have the retained earnings statement,
Yeah.
and then the balance sheet, which is like a snapshot of the company's assets, liabilities, and equity at a specific point in time.
Okay, so like the race isn't over yet. What happens at the end of the cycle?
We hit the reset button.
Okay.
So we make closing entries. It's like zeroing out the stopwatch, so we're ready to the next race.
Okay.
And we post those to the ledgers, and then we're ready for the next month financial reporting.
Cool. So it's like the runner's getting ready for the next set of laps.
Yeah.
Now, what about the retained earnings statement? I don't really get where that fits in.
Yeah, so it's kind of like a bridge between the income statement, which shows the profit for a certain period,
Okay.
and the balance sheet, which shows the company's overall financial picture at a specific point in time. So retained earnings keeps track of the accumulated profits over the life of the business.
So like all the laps.
Yeah, exactly. It's the total time for all of the laps the runner's done.
Okay, so it's like the big picture
The big picture, yeah,
of profitability over time.
exactly.
Okay, cool. Let's dive into some of the different types of accounts
Okay,
that kind of make up this financial ecosystem. So starting with assets,
sure.
what are some examples besides just cash?
Well, you have accounts receivable, which is money that's owed to the business by its customers.
Okay,
So it's kind of like an IOU.
right.
And then you have notes receivable, which are more formal. It's a written promise to pay a
Right.
certain amount, usually with interest.
So both of those are assets because the business expects to receive that money
Exactly.
in the future.
Yeah.
Okay, what about prepaid expenses? I feel like that's like paying for a college semester up front.
You got it. It's
Yeah.
paying for something before you've actually used it all up.
Right.
So like prepaid rent, insurance. Okay.
The unused portion is an asset because it represents future benefit for the company.
Okay, that's interesting. Now, what about accumulated depreciation? It sounds kind of like assets are like losing value over time.
Yeah, that's exactly what it is. It's
Uh-huh.
like when a car loses value as it gets older.
Right.
So depreciation spreads the cost of an asset
Yeah.
over its useful life,
Right.
and it recognizes that it's not going to be worth the same amount
Over time.
over time. Yeah.
So we're accounting for like wear and tear and
Yeah, or like it becomes obsolete,
right.
that sort of thing.
Let's talk about liabilities.
Okay.
What are some common types?
So we have accounts payable, which is basically the opposite of accounts receivable.
Okay.
So that's what the business owes to its suppliers.
Yeah, sure.
For goods and services it's received but hasn't paid for yet.
Okay.
Then there's notes payable, which are formal loans that the business has taken out.
So accounts payable are kind of like short-term IOUs to suppliers.
Yeah.
And notes payable are like those formal loan.
More formal agreements. What about unearned fees?
Yeah. So imagine you're a gym
Okay.
and someone buys like a year-long membership up front.
Okay.
So you've received the cash, but you haven't actually provided all of the services yet.
Right.
That money is a liability because you owe those members gym access for the year.
So you're kind of holding on to that money until
Yeah.
you've actually earned it.
Exactly. And Jonick really emphasizes this idea of matching revenue and expenses.
Yeah.
So you wouldn't record all the revenue for that gym membership in the first month.
Right.
You would spread it out over the year as you provide the services.
Right. So it's like you're accurately reflecting
Yeah.
when the revenue was actually earned,
Exactly.
not just when you got the cash.
Right.
Okay. That makes sense. So now let's talk about adjusting entries.
Right.
Why are those so important? Like, can't we just record transactions like as they happen?
Sometimes we need to make adjustments to reflect changes in asset values or to recognize revenue that's been earned but hasn't been billed yet, or expenses that have been incurred but not yet paid.
So it's like fine-tuning those.
Yeah, we're fine-tuning the records to make sure everything is accounted for correctly. So for example, let's say you prepay for a year of insurance.
Right.
You wouldn't record all of that expense in the first month.
Right.
You'd adjust the records each month to show how much insurance has actually been used up.
So you're making sure that the expenses are matched with the period they actually benefit?
Exactly. And if you don't do this, you can end up with some pretty big errors on your financial statements.
So it's like making sure that the runner's lap times are like
Yeah.
accurately recorded because
Written.
every second counts.
Every second counts, yeah.
I feel like this is really starting to come together.
Yeah.
Jonick does a really good job of breaking down these like complex concepts.
She does. She does.
And we've only just scratched the surface of
Yes.
accounting.
Yeah. But this gives us a really good foundation
Yeah.
to kind of move forward.
Yeah. Now, Jonick kind of shifts focus to merchandising businesses.
Right.
What makes those different from service businesses and what new accounting challenges do they bring?
Well, instead of providing services, merchandising businesses sell products.
Okay.
So that brings in some new accounts like merchandise inventory,
Okay.
which keeps track of all the goods that are available for sale.
Gotcha.
And instead of fees earned, we have sales to keep track of revenue.
Right.
And then we have cost of merchandise sold, which is the expense of the products that were sold.
So it's like we're adding all these like specialized containers to our sorting system.
Exactly.
Okay.
And with inventory comes inventory valuation methods like FIFO, LIFO, and average cost.
FIFO, LIFO. I feel like I've heard those before, but
Yeah. So imagine you have a shelf full of products.
okay.
FIFO, which stands for first in, first out, assumes that the oldest items get sold first.
Well,
LIFO, last in, first out, assumes the newest items are sold first.
Oh.
And then average cost just uses the average cost of all the items.
so it's like choosing which items to pull from the shelf
Exactly.
based on like when they arrived.
Yeah.
And this choice can actually impact the company's profits.
Oh, absolutely. Especially during times of inflation.
Wow.
The method you choose can really affect the cost of goods sold and ultimately the bottom line.
So even something as simple as like what order you sell things in
Yeah.
can have major financial implications.
It can.
Wow, that's fascinating. Okay, now Gonick also mentions bank reconciliations.
Right.
What are those?
That's basically just making sure that your records match the bank's records.
Okay.
So you're comparing the two, looking for discrepancies.
Okay.
It's a really important internal control
Yeah.
to safeguard cash because that's probably a company's most important asset.
So it's like double checking the runner's lap times
Yeah.
against the official timer.
Exactly.
Okay, cool. And then they're also fixed assets.
Yeah, so that's things like property, plant, and equipment. And then intangible assets, so patents and copyrights.
Right.
Understanding how those are valued and how they depreciate
Yeah.
is really important.
Yeah, okay. So we're moving beyond just like those short-term price
Right.
actions.
Yeah, we're starting to look at the long-term
Okay.
value of the company.
Now, what about investments? How do those?
So just like people, companies can invest their money.
Yeah.
They might buy stocks or bonds or other investments.
Yeah.
And there are rules about how to record those,
Right.
keep track of them, and account for any gains or losses.
So I feel like things are about to get a lot more complex,
Yeah.
but I think we've laid a pretty good foundation with this first part.
We have. You're well on your way to becoming a financial detective.
Now, in the next part of our deep dive, we're going to go even further into specialized accounting,
We are.
looking at payroll, bonds, and the ins and outs of stockholders' equity.
It's going to be good.
So stay tuned.
Yeah, stay tuned.